join us on the And we're back for segment 4 of podcast 4. You listen to IBGR, the International Business Growth Radio Network. My name is William Eastman. I'm host for today's show. And this series is on new business economics, and we call them this neo world. Okay, I'm just playing off of the Matrix. And so the idea behind this, we had this show for a couple years now, and we run it off and on. We don't run it every season, but it was called Economics for Business Owners. We're just trying to sex it up a little bit. The idea behind this is that as business owners, entrepreneurs, we don't control what happens in the economy. What we control is how we respond to it. So if we are able to read it better, then not only can we respond in the here and now, but if we read it better, we can also get predictive, because it is predictive, and we can get ahead of it. And so that when good times come, we take more of the money off the table than our competitors. When bad times come, we come out of it better than they do, or we come out of it and they don't. All right, so let's finish up the last piece, and we're going to talk about what are the indicators. So go to the website, ibgr.network. That's ibgr.network. When you get there, that's our URL, our broadcast frequency. You'll see resources on the navigation bar. Mouse over, hit show notes. Go there. If it's not available to you right now because of all the shows we got in the queue, then new choice for business search, simply put in show 2. What do I need to know, and play the curve. Now, segment 4, the last one. This is really pulling it all together. How do I look at what's going on in the marketplace and determine what's happening? So where do I look? So I'm going to give you 3 that I use that are, and I tell you what, if you talk to your stockbroker, I'm not sure in a generic sense it would be much different, because the one thing about Wall Street is that getting data on Main Street is more difficult. Getting data on Wall Street is pretty clear, because the Dow is traded, or the NASDAQ or whatever is traded all the time, and you have the numbers up. Okay, so I'm into segment 4, podcast 4, economic basis for owners, how to read the business cycle tea leaves. So we're into tea leaf reading right now. All right, so if we start the conversation at the end of a recession, depression, contraction, right, we're in the trough of the wave, and a new expansion is coming on us. Let's start here. So one of the things that it'll tell me is prices have stabilized. In other words, what I'm beginning to see is the prices that we can charge, our competitors can charge, or in any economy, in any industry, they've stabilized in terms of nobody is discounting their pricing anymore to get anything moved. Because what has happened, as we talked about in the previous segment, is that demand has gone to low, maybe to zero. And so initially we had all this excess capacity, the positive bubble, that had to be, basically sold down. Now we're into and coming out of this negative bubble where everybody believes that it's never going to get better, it's horrible. And so more than likely, there's not much supply of something, whatever it is that we're talking about. There's not much in the inventory. There's not much happening on the manufacturing end to make it. Why? Because there is no stimulus for it. Also is that there's probably no business credit available. So I am certainly not going to take any chances. So what happens here is that I begin to look at the market. And typically the stock market is one of the leading indicators of the change. Not the sole one, but it is definitely one of the indicators. And what you begin to see is a shift in what's traded. Because typically what you have is, and this is a gross stereotype of stocks, right? So take it with a grain of salt, is that you have growth stocks and you have commodity stocks. The commodity stocks have things like entertainment, alcohol, guns, things of that nature, staple goods in a recession. Those stocks, I'm not saying that they're making a lot of money, but they've got some positive performance, because what's happening is that people are buying the things they got to buy, and then they're buying things that are kind of either based on fear or based upon delusion. In other words, why has entertainment costs gone up in the past? Because people want an escape from the situation they're in. Why do people buy firearms, weapons? The reason they buy it is because they're feeling insecure in what's going on, and so they're going, well, man, I better protect myself. So those type of commodities are hot in a contraction. And a growth stock, because typically what happens is the commodities pay dividends. And the other way of looking at it is if they're making money, pay dividends. So even though the dividend may be down and it's not as big as you would have got in an expansion, it's still something. Growth stocks, on the other hand, only work when the economy is roaring, number one. Number two, typically they reinvest money back into the firm. And so these are typically, you don't buy these to get a quarterly or a semi-annually or annually check from them in terms of, well, here's your dividend on your stock. You're having them reinvest. So stock market performance is a good place to look in terms of who is beginning to gain. Where are the big investors moving from, and where are they moving to? That is an indicator of what's going on, and it's a shift in the market, number one. And so market performance, who's becoming the smart investment? Number two is the availability of credit. Is the second thing you begin to see, is that banks are beginning to ease up the credit because the banks have taken the same hit that you've taken. Now, of course, since the Obama administration and the use of quantitative easing, this has changed somewhat because up before then, the only way that a bank made money was by making loans. And so during a recession, the bank is in the same spot you're in, is they're not making any money. Why? Because they're not loaning any money. And the reason they're not loaning anybody is that it's a risky environment. What they have to charge for the risk is going to go up. And quite frankly, if you're a business owner and you're not sure that you can repay it, why would you borrow it? And so most of us business owners are a little bit smarter than that. And so the availability of credit is there. How much is available and what are they charging? And what you would begin to see is new credit offerings coming out, either from the banks themselves or from alternative funding institutions. And then you take a look at PPI and CPI. And as we talked about in the last two segments, PPI is the Producer Price Index. And really what this is talking about is it's the emotion. How positive is the emotion with people who make things that they ought to start buying and start building more supply in anticipation of more demand. And this is also a great indicator. They got manufacturing managers or purchasers survey. I could look it up here, but basically you got the people who buy from manufacturers and when are they making the purchases. But look at the PPI, and the PPI will also tell you a lot. I didn't put it on the list here, and I'll add it to the notes here when I get an opportunity. It's the same with inflation. Where are we on inflation? Because typically in an expansion, inflation is taken off. Now, without getting too much into econ, let me separate two things here. Prices will increase in an expansion because of the increase in demand. We've already talked about that in the previous segments. But also what happens is that the government also begins to inflate the money supply, and when it does, that is also inflates prices. I'm taking a traditional definition of inflation, and that is simply when the government prints more money, and therefore you have more money chasing fewer goods. That lowers the value of that money. So if the dollar was worth $1, and then you added 25% more money to the money supply, it doesn't take it down by 25%, but suddenly your dollar's not worth $1; it's worth 93 cents. So the price is going to go up correspondingly because that dollar doesn't buy what it used to buy, or that euro or whatever currency that you're using. And so you want to take a look at that and what's going on. But PPI to me is the greatest one because that's the leading indicator. CPI is that you would see here is Consumer Price Index it's no longer falling. It's become stationary. In other words, whatever level it's at, it's now been kind of stuck there for a little bit of time. If I see that plateaued, then that tells me also that we're beginning in an expansion. Now, of course, we can turn it around and look at it the other way around, and that is when you're at the top and you're at the crest and you're in the middle of the bubble, credit is cheap. I mean, go back to the 2007-2008 financial fiasco. It wasn't a banking crisis. It became one, but it wasn't. It was a housing crisis. And what it did in the United States, it made it possible for anybody to get a house. And the reason for it is that the loans were underwritten by the government. And so credit was just free, free, free. People took advantage of it. The banks, who typically are a little bit more sober about who they lend money to, went, hey, the government's guaranteeing this loan, so guess what? We know that in 6 months these people are going to default. We're going to take the house back and we're going to flip it, so to speak, and we'll sell this house 2 or 3 times and make good money off of it. Except that when everybody defaulted, and that's what happened in 2007, 2008. Okay, so it doesn't matter which way we're going in the cycle. What I'm looking for are trends. If all the financial advisors, including yours, are saying move the commodities, it looks like you're coming into a contraction. When credit starts getting tight, you're coming into a contraction. Is inflation gone up? You're coming into a contraction. If the PPI and the CPI are both down and trending down, you're coming into a contraction. On the other hand, reverse that, and that's the positives. All right, so next week, what are we going to do? We're now going to take that. We're going to take that first piece from the trough up until the first inflection point where price and value equal. We're going to take that and say, if that's where you are in the market, which, by the way, is not where we are right now, then what do you do? And the following week, we're going to take the next one, which is where we're at. You're between that inflection point of when price and value were equal, and now we're into the positive bubble, and we're working our way at the end of the expansion, which is, I believe, where we are. And we'll talk about that. So each week, we'll take it apart, and we'll talk about what you need to do. All right, so the last thing I want to say to you is here at the bottom of the page, I talked about Facebook, LinkedIn. Let me go back to the app. There's no better way to interact with us and to get access to everything we do. And we do a lot here. That mobile app, and you can click that link, or you can go to ibgr.app, or you can go to the Apple Store or the Google Play and put in either IBGR or Business Growth Radio, doesn't matter, and up it will pop, and you download, and suddenly you have access to everything in our system. That's why we called it Solutions on Demand in the palm of your hand. All right, with that, thanks for listening. It's a great Monday. Great to be here. My name is William Eastman. I am your host. You're listening to IBGR. This is show 2. What do we need to know and play the curve? Have yourself a great business day. Go nowhere.